When we talk about the institutions that control global finance, we usually hear two names, Vanguard and BlackRock. But there is a third pillar, one that operates almost entirely in the shadows. This chart shows State Street Corporation's assets under custody. Here is what $49 trillion looks like. It is larger than the combined GDP of the United States and China. Alongside Vanguard and BlackRock, State Street is the collective largest shareholder in 88% of the S&P 500. They hold a structural vote over the American economy. Yet this modern superpower did not begin on Wall Street. It started as a deeply conservative local bank in Boston, chartered in 1792 by John Hancock to serve ordinary farmers and tradesmen. Over 234 years, this institution transformed from a local lender into a global controller. Today, it faces legal battles over its role in energy cartels and the systematic skimming of its clients' retirement funds. For its first 100 years, State Street, then known as Union Bank, had a very simple business model. People deposited their money, and the bank kept it safe. While other institutions gambled on speculative investments to chase high returns, this bank refused. That strict conservatism paid off. During the Civil War, the American financial system fractured. Southern banks collapsed, and Confederate currency turned into worthless paper. State Street simply accepted a new federal charter, kept its books balanced, and never missed a dividend. When the stock market crashed in October 1929 and thousands of banks went under, State Street held the line. They operated as a custodian, an institution whose primary job is to physically hold and safeguard securities for investors. They were a vault with a brain, securing assets instead of risking them. They proved that to build a financial empire, they didn't need to take massive risks. They just needed the market to believe they were the most reliable vault in existence. By the late 1960s, trading volume exploded. Wall Street was literally drowning in its own success. Every trade required a physical paper certificate to be matched, signed, and delivered by clerks. Brokerages collapsed simply because they couldn't process the paperwork. While New York panicked, State Street saw a market. In 1975, they hired William Edgerly as CEO. He wasn't a banker, but an NIT-trained engineer, and he realized the future of finance wasn't making loans, it was processing data. Edgerly made a radical decision. He began shutting down the firm's commercial lending and retail branches, pouring resources into massive IBM mainframes. He transformed a nearly 200-year-old bank into an automated information processing factory. That infrastructure positioned them perfectly for a 1993 invention called the ETF, or Exchange Traded Fund. The first of its kind, the S&P 500 ETF, ticker symbol SPY, allowed ordinary investors to buy a basket of top stocks as a single share. State Street engineers built the underlying digital plumbing to process hundreds of individual securities in a matter of hours. SPY became the most heavily traded security on Earth, eventually holding nearly $700 billion. As mutual funds and ETFs boomed, State Street's custody assets skyrocketed, turning a regional New England bank into the vault for the modern investment industry. Owning the digital pipes that settled and tracked these trades gave State Street a new form of influence. By processing the daily movement of trillions of dollars, they effectively controlled the plumbing of the global market itself. But managing $49 trillion creates a dangerous temptation. Sometime in the late 1990s, the institution that had built its entire reputation on safeguarding client assets began quietly skimming them. This diagram illustrates how the foreign exchange scheme worked. When institutional clients traded international securities, they needed to exchange foreign currency. State Street promised to secure the best possible market rates. Instead, they applied predetermined uniform markups to every transaction. The client saw an inflated price, and State Street pocketed the difference. They did this for 11 straight years. These markups were institutional. Inside the Transition Management Division, executives coordinated to add secret commissions to large portfolio trades. One executive casually asked a colleague, "How much do you want to take?" They then manually deleted the commission data from final reports to hide the theft. The victims were not Wall Street speculators. They were the retirement plans for teachers, firefighters, and British postal workers. The very people John Hancock's original charter was supposed to protect were the ones getting fleeced. The drive for technological scale redefined the company's relationship with its clients. The institution built to safeguard public funds had begun to exploit the very vaults it was paid to manage. Today, the threat has escalated far beyond skimming transaction fees. In late 2024, the state of Texas sued State Street, Vanguard, and BlackRock, accusing them of coordinating to manipulate energy markets. Because these three firms collectively own a massive percentage of American energy producers, the lawsuit alleges they are weaponizing their voting shares. The claim is that they are actively pressuring coal companies to reduce production and adopt green energy targets. This raises a complex legal question. When a few giant custodians coordinate to influence corporate policy across an entire sector, is that responsible environmental stewardship, or is it an illegal corporate cartel dictating market behavior? The vault is now large enough to exert direct pressure on the markets it stores. Its influence allows it to shape the economic outcomes it was originally chartered to protect. State Street's history suggests that when a single entity owns the digital plumbing of global finance, it does more than participate in the market. It dictates how that market functions for everyone else.